Good afternoon, ladies and gentlemen. This is Jim Bell, President and Founder of Bell Investment Advisors. Thank you for joining us today for our webinar that's going to include an update on important estate planning information, and we're going to feature the role of insurance in that context as well. So I'm joined today by two experts. Tom Bret is a very well-known estate planning specialist attorney here in the Bay Area. He's with the firm that he co-founded with Mark Cederborg, the firm of Cederborg and Bret in Walnut Creek. Tom is a certified public accountant as well as a certified financial planner as well as a estate planning attorney specialist. So very happy to have Tom with us today to start us off with an update of the latest situation and context for estate planning. As you know, that keeps changing, so we need to stay up to date. And then I'm also joined by Don Morris, a CLU, a Vice President of Sitzmann, Morris & Lavis Insurance Agency here in the East Bay. Don's also a very experienced professional in estate planning insurance solutions. Really thank these two gentlemen for joining us today. We're very proud of our professional network of help that we've built for almost 24 years now at Bell Investment Advisors, and these two gentlemen represent the quality there that we're very proud of. If you're having any trouble with hearing or seeing the graphics, you can call our office at 800-700-0089, 800-700-0089, and our staff can help you out there. Okay, Tom Bret, you're going to start us off with a review and update of what's new in the world of estate planning.
Thanks, Jim. So our first slide, tax-free estate to non-spouse. I think everyone's familiar that you can leave an unlimited amount of assets to a surviving spouse. So we're dealing primarily here on this slide with the amount that can be left by a decedent to children, grandchildren, other heirs. The two columns are prior law in effect from 2002, scheduled to go through 2014 with the exemption amounts for each taxpayer. So for a married couple, that would be double these amounts that their joint estate could be left estate tax-free after the second death. Current law from 2010, I think everybody knows that we've got a $5 million exemption, and it's indexed by the CPI. So in 2014, we have a $5,340,000 exemption for each taxpayer. On the next slide, I'm showing that the exemption amount is indexed back to 2010, and is scheduled to increase now in 2015 by the CPI. That is measured by the change from August to August of each year. The Internal Revenue Service will not release the amount for 2015 until next month. Last week, Bloomberg Financial did release a set of projected amounts, and they're projecting that the exemption will go up $90,000 to $5,430,000 per taxpayer. Earlier projections were that it might only go up $80,000. For future planning purposes, if we have some economic recovery and CPI creeps back up into the 2s and 3s, you can see that the exemption is probably going to be increasing by $125,000 per year, as it did for the first 2 years in 2011 and 2012. So just touching on the terms, A trust, B trust, C trust, very common way of describing trusts that are created from a revocable trust, a family trust, after the first death. And always found it confusing myself personally. I don't like to use it. Some people would classify that marital trust under the C column as a B trust in a two-trust document. So I always use the name of what the trust does. The survivors trust holds the survivors half of the community property, and they also have their separate property. The B trust is the amount that can be left estate tax free. The bypass trust, exemption trust, credit shelter trust, whatever you want to call that. And then finally, the marital trust and the three trust situation is the amount in excess of the decedent's share of community property and separate property. And the tax on that is going to be deferred until the second death. It does not escape estate tax, but it does get deferred. Just a quick touch on the estate tax. When you're doing planning, it's common to just refer to the top tax rate as 40%. We have a graduated tax rate system where the estate is added up and the tax computed, and then a credit is applied. So if you're transferring $10,000 as a gift, you're really only saving $1,800 in estate tax, not $4,000. So the difference is $55,000, $54,000 between the two amounts.
So Tom, just for clarification, if you had an estate in today's environment that was $20,000 over the mutual marital exemptions, on that $20,000 that exceeded the exemption amount, you would pay an 18 to 20% tax rate on it? Is that the way I can understand that?
No, not quite exactly that way. In that scenario, you would be saving 40%.
Okay.
On the excess over the $5,340,000, but you're not saving 40% on the first $5,340,000. So that if someone has a substantial estate of $20 million and they're gifting during their lifetime $5 million, that's where that would apply.
Okay, thank you.
Our next slide is traditional planning. It's what is in place probably for 80% of all estate plans that were created before 2013. Typically, on the first death, all of the estate is left outright to a survivor or perhaps in a trust for the benefit of the survivor. More commonly, what we see is the joint estate is split 50% to the survivor's trust and 50% to the bypass trust. Now that assumes there's no separate property of the first decedent. If there is, then that separate property would be all placed into the bypass trust of the decedent if it was the decedent that owned it, or it would go into the survivor's trust if the separate property were the survivors. It's important to understand that in this scenario, the bypass trust is irrevocable. The spouse typically receives all the income, although it's possible to sprinkle the income among children as well. The spouse does have a limited invasion for the principal of that trust to provide for what's called an ascertainable standard, which we'll just say is health, education, and support. Another factor typically not realized is that because it's irrevocable, that bypass trust has to file its own income tax return every year in addition to the beneficiary filing their personal tax return. Our next slide, again, joint estate, assuming no separate property for a married couple whose estate exceeds the two exemption equivalent amounts, $10,680,000. So we're still providing all of the survivor's assets to go into the revocable survivor's trust. The bypass or exemption trust receives the $5,340,000, and if the decedent has a 50% share that exceeds $5,340,000, that would go into the marital trust. And typically an election called a qualified terminable interest property election is made, which the acronym would be QTIP, and there's no estate tax on that excess at the first death, but there will be a tax later on. Again, an income tax return required for each trust. We're also not addressing the issue of generation skipping transfer tax in this seminar. The amounts that may be left to a second generation, grandchildren primarily in this case, may be subject to a secondary tax or a double taxation when it exceeds the $5,340,000.
So John, the marital trust is a tool to defer tax on large estates until the second death. Is that be one way to interpret that?
That's correct. So typically, a married couple would want to provide as much opportunity for income for the surviving spouse as possible, and typically there are no large bequests at the first death, although depending on the estate size it can be done. When you do have an estate that is that large, typically there may be lifetime gifting, which would consume that $5,340,000 exemption, at least in part during the lifetime, and then whatever is left over can be used at the second or at the first death. So now I'm going to touch base with this one on what could happen, some of the traps, when an estate plan is done kind of in a vacuum, where you're really only just drafting a document to divide up the estate, but not looking at what the makeup of the estate assets are. So in this example, we have an individual retirement account of $2 million, a personal residence of $800,000, and some other assets, some savings and such that might be $200,000. Remember, in that traditional planning, the decedent's 50% of that $3 million total asset estate is supposed to go into the bypass trust. However, $2 million is in an individual retirement account. Wills don't control IRAs. Trusts do not control IRAs. An IRA is a contract between a participant in a qualified plan or in an IRA rollover with the custodian, and the custodian pays that IRA to the person that is designated as the beneficiary. So it's important to keep your beneficiary designations up to date. But in this case, we don't have enough funds to put $1.5 million into the bypass trust, so you're going to have to put a personal residence into the bypass trust and the other assets in there. And that's really not desirable because if the surviving spouse wants to sell the residence and move into assisted living or to downsize, there's no Section 121 exemption for the $250,000 that you would receive during your lifetime on the sale of a house, or every 2 years. It's not available there. At the second death, there's no step up in basis on the home either. And just quickly, step up means that something purchased for $10,000, if it's worth $100,000 at death, the person's inheriting that property will have a basis of $100,000 to measure future gain or loss by. So the American Taxpayer Relief Act of 2012 provides for a permanent extension of the $5 million exemption with CPI increases, and it also retained part of the 2010 Act that gave us the $5 million to begin with for 2010 and 11. And that's called portability, or under the tax law, decedent spouse unused exemption. So we have a first death. There's an exemption of $5,340,000. If it's not used, if all of the estate is left to the surviving spouse, remember the unlimited exclusion for the spouse. So none of the $5,340,000 was used. That unused exemption amount ports over to the surviving spouse, who then has $10,680,000 plus a CPI increase on their own share. In order to have portability, you have to file an estate tax return for the first death. It's simplified reporting. You can use estimates, particularly where it's all going to the surviving spouse. appreciated assets, and so no formal appraisal may be needed, and you do have to make sure that the election is present on the estate tax return. The portability feature does have some complexity if the surviving spouse should remarry, and depending on whether it's the surviving spouse that dies before the second spouse or the second spouse before the surviving spouse and so on, but that's beyond our scope today. So now on the next slide we're going to go back and readdress that earlier example of the $3 million estate where $2 million is in an individual retirement account. Typically today when we have less than two exemption amounts, less than $10,680,000, we put everything into a survivor's trust. The elimination of the irrevocable trust and the income tax return is beneficial to the survivor. Survivor has complete ability to revoke the trust, amend the trust. There are no tax returns required, and at the second death, the spouse has their choice of heirs. A caution, obviously, is with the second marriage. This may not be appropriate because usually on a second marriage, each spouse is bringing assets into that second marriage, and they have a desire for their assets to be left to children from a prior marriage. You'll see the disclaimer trust box. So even though everything's left to the survivor, we still provide in the instrument for a trust to be the receptacle of assets that the survivor might disclaim. A couple of reasons they may do that. They may feel that they have sufficient assets that they don't need them, and they'd like to have the children receive part of the estate after the first parent passes away. Another possibility is that the estate tax law may change, and in fact, since 2013, each budget for the last 2 years, there's a companion green book which describes all the revenue proposals that go into the budget. And for the last 2 years, the administration has proposed to eliminate the $5 million exemption and the CPI indexing and leave it at a flat $3.5 million. So the disclaimer trust gives us some flexibility. If we go back to that example with the $2 million IRA, in this situation, the IRA will be sitting by itself in an IRA custodial account, but now the residence and the other assets are going to be in the survivor's trust, which gives them so much more flexibility. By the way, another note on that, even though in that example of $3 million, one normally wouldn't think about life insurance as a necessity, but in reality, another part of that Green Book proposal is that the so-called stretch IRA, which allows an inherited IRA to be taken over the lifetime of the beneficiary, the administration has proposed that it can no longer be stretched out any longer than 5 years after the date of death. So life insurance would be a great vehicle to pay for the income taxes on taking out the IRA. So you can imagine about an $800,000 income tax on a $2 million IRA. Techniques for reducing the estate tax, I have a list of 3 major elements. There are many, many other elements by which the estate tax can be reduced. I think we're all familiar with the outright gifts, $14,000 from each donor to each donee. So a married couple could give each child $28,000. If they're willing to do, it would be $56,000 to a child who's married, if you include the spouse. Value reduction techniques, it's often common to split an asset into fractional interests and create transfer restrictions or create multi-owner entities such as a family limited partnership. Here again, insurance is a good vehicle to create liquidity because the multi-owner entity may not be able to dissolve and allow estate taxes on the second death. And then irrevocable trusts, such as a qualified personal residence or a grantor retained interest, and charitable remainder and lead trusts. Again, these are areas, especially in irrevocable trusts, where life insurance has a significant part of the planning process.
All right, thank you, Tom. And as Tom went through that, if you have questions, you should be able to see a box on your slide where you can submit questions to us, and we'll try to answer as many of those as we can. If we don't have time to answer your question, we'll make sure to get an answer after the broadcast is over. So now we're going to bring in Don Morris, our insurance expert, and he's going to proceed for us now that Tom's set the context of where we are in the estate planning environment.
Thank you, Jim. Appreciate it. Hello, everybody. First of all, you just heard Tom eloquently talk about estate tax reduction strategies. I'm here on this part of the program to talk about estate tax payment strategies. In other words, at the end of the day, after Tom and your estate planning attorney has done his or her quality work in reducing your estate down to the lowest common number that you see fit, with the trade-off being income and control, as Tom knows, when you're doing planning like that, there becomes a number at the end of the day that potentially is going to be subject to federal estate tax. And Tom went through what that current limitations are, and I'm going to take you through that as well. But many of you probably already have existing insurance portfolios out there, and the key thing that Jim and Tom believe is that this is a advisor team in any kind of situation you work in, with your CPA, your estate planning attorney, your wealth manager, and your insurance professional, to make sure you monitor your programs on an annual basis. Because what we found at Sitzmann, Morris, and Lavis is so many uncovering of broken insurance portfolios, because the life insurance advisor has maybe, how do I say, vanished from the scene. Since in the insurance world, about 9 out of 10 of us don't survive through the third year of the business, and so sometimes they sell a policy and they leave. And unfortunately, with a life insurance policy, they are embedded with performance assumptions. Some are fully guaranteed, but a lot of them have assumptions baked into them. And if you set it up on the shelf and you forget about it, then the very liquidity that you were planning to get from your insurance may not end up being there at joint life expectancy when you're going to need the parachute. I always say, when you get in an airplane, you put a parachute on your back, you want to make sure that you jump out of that plane, it's going to open. And so it's just a reminder, make sure you review any insurance program annually and get what I call in-force recreation ledgers from your insurance advisor on an annual basis. Because again, when you bought it 10 years ago, you may have remembered your insurance advisor telling you something about that product, but as time has gone on, you tend to maybe forget what he or she said. Well, getting an in-force recreation is your best fiduciary protection, especially if you're a trustee of one of these irrevocable insurance trusts that Tom mentioned that owns this policy, to make sure you're covering your ground, that the policy is performing so that it's going to be able to deliver the tax-free block of money at exactly the time it's going to be needed, which is generally out past life expectancy.
And Don, your term in force, that just implies that this is what the insurance policy is lined up to distribute in the present tense.
Correct,
yeah.
Correct. Because some of these policies were baked with assumptions. Interest rates have dropped since 1989, and so there's different results that each client should be aware of. Jim,
great,
good point. So I list a little bit of helpful questions that I would want to know if I was a trustee or a policy owner on policy performance. And again, make sure you do that at least annually. And then for tax efficiency, make sure that your coverage, and I know Tom would echo this, is owned in the proper place, because life insurance, if you have an estate that currently exceeds the exemption, the two exemptions of, say, $10.5 million that's owned in your estate, really, Tom, you're just kind of pouring fuel to the fire in that death benefit coming into your taxable estate will then be taxed at 40%. And that probably wasn't the intention of the person taking out the life insurance.
That's right.
which they could have avoided by having either their children own the policies outright or an irrevocable life insurance trust own it and get it out of their estate. So I think that's a key point for us to consider as well when we look at reviews.
Now, this chart's going to be a little bit hard to read. I did want to let you know that we will make these slides available to you. Just email us and we'll send you the deck. And we are recording this presentation as well, and we'll save it on the Bell Investment Advisors website. But Don's going to tell us what we can't read.
That's exactly right, Jim. That's what I do daily in my office. No, but here's a sample restructure analysis. When I say let's look at your policy annually, sometimes you uncover that the policies are broken. And here we had a client who had 2 policies, and they were paying premiums, and those scheduled premiums are under the total column. And cumulatively, for a $10 million policy, they were scheduled to pay roughly $1.4 million in premiums over the next 15 years. We were able, and the policy, even paying $1.4 million in premiums, the policy was going to lapse, crash, not have any more death benefit care protection at age 88. Well, the client said to me, Don, we have good life expectancy in our family. I need this coverage past to, let's say, age 95 at least. This isn't working for me. Well, we were able to go in, even though the client bought this older policies 6 years ago, they had aged 6 years, he had aged 6 years, we were able to show them restructured current new policies with the same assumptions, because they were all 3 guaranteed insurance contracts, and we were able to lower his premiums by a factor of around $472,000 over the next 15 years with the same death benefit and elongate his coverage period past age 100. So you say, how can this happen? Well, what has happened is life insurance policies have become more efficient because they are assuming different, better mortality assumptions in the last 6 years than when the original policies were taken out. Insurers can pass along those mortality cost savings in the form of lower costs of insurance inside those policies, thereby creating this advantage to possibly replace their in-force coverage. You would do this on an IRSC 1035 exchange basis, meaning you would move it from one company to another that, let's say they had investment gains in there, you would pay no tax on transferring those policies via this process, and you would just start paying the new premium schedule that is over on the far right column. So again, I just want to make everyone aware you have in-force coverage. You should review it annually because there are savings even if you've gotten older and maybe even if your health has deteriorated since point of issue. And that's very key for trustees of insurance trusts to look at as well. Well, as Tom touched on the estate tax, what I like to say is Uncle Sam comes in for the estate tax and they do a cashectomy. If you think about a ball and you think about a Tootsie Roll, in the middle is all of the client's assets, and those are liquid assets. All of the part around the Tootsie Roll center may be real estate, family businesses, stock, bond portfolio, art collections, you name it. The IRS wants their money, and they want it within 9 months, and they want it in cash. So if you're a very liquid estate, sometimes what I'm going to tell you in these following slides may not be that exciting to you. You may choose to leave enough cash in your estate and have your heirs pay the 40% tax on the amounts over $10.5 million with the cash that's in your estate and not purchase life insurance or a block of money, liquidity. Other clients look at this as a business transaction that makes good sense for them today to make some current gifts to an insurance policy so that they basically can preserve their entire estate. Maybe they didn't want to sell that family vacation home or that real estate asset that they have, and they wanted it to stay in the family, and they didn't want to refinance it at their death. So life insurance is a real good vehicle to provide liquidity at the exact time it's needed. The next slide I'll touch on briefly. Clients always say, well, Don, my estate today is only $10 million. I don't have an estate tax problem. Well, you heard from Tom say that the estate tax has changed, I think, since 1913. I forget how many times, Tom, but quite many. I think it's like 7 or 8 times for sure. And we don't know what Congress will do. But we do know that under indexing, and if you don't spend your entire estate, and here's a factor where if you grow your assets today at 5% net after tax, your estate tax being progressive is going to grow from roughly 23% to roughly 27% 20 years hence. So if you're 65 today and you do nothing, don't do any gifting in your estate, your problem is going to grow as you age. So you need to think about that. We talked about in this slide the life insurance solution and the reduction techniques. I generally come into play after Tom has done the estate planning and gotten the estate in order to where the clients feel that they want to be in terms of giving away assets or creating family structures. Then there's an amount that might be subject to federal estate tax. Well, if they're concerned about that and they view that they want to pass on their entire estate and they want to make sure that their wealth is maximized and that they can assume and assure an equitable distribution of assets, because in some situations you may have a son or daughter in the business and a son or daughter not in the business. Well, life insurance is a great tool for equating that difference at death, where the daughter may be getting the family business and the son, who might be an artist and doesn't have any interest in the family business, but you don't want to disinherit him, you provide some insurance planning there. So I just think that what I found in my 33 years, and I'm sure every gentleman here will echo, money helps at the time that it is needed, and life insurance provides that kind of solution. I won't spend a lot of time on this next slide because I think you can read it, that you could liquidate your assets to pay the estate tax, but that costs you 40% of the cost plus selling costs plus any discounting costs. Plus, you know, dying, never fun, obviously, but never a good time. We may be in a low interest rate environment today, but let's say you're a real estate family or you have credit reliance, and we're back in the mid-1980s or early 80s when interest rates were at 12 and 13%. It may not be viable for the family company or the real estate to get refinanced at that time. So again, it's a hedge against the vagaries of the market and avoids forced liquidation. Not many of my clients that are worth a significant amount of money retain 100% in cash. They generally got wealthy because they plowed it continually in investments where they lock up their money. So again, I don't run into too many clients that are 100% liquid. You can't go to your bank and ask for a loan for estate taxes. You can, however, go to the government payment plan, which Tom's familiar with, called Section 6166, that will allow you interest and principal payments over time, and not the scope of this discussion for us to touch on that. But again, while many of my clients might have a qualifying event under Section 6166, they still find that purchasing some liquidity is a good idea to supplement that. Or they could look at life insurance, which I'm glad to talk to them about. Again, we said let's not make sure that we own this insurance improperly because it would add to estate tax when death happens. We frequently find our clients getting with their estate planning attorney and creating a third-party ownership structure where an irrevocable life insurance trust would be the owner and beneficiary of this insurance that basically is going to be there to settle estate taxes. Here's a diagram of how that works. You have to qualify your gifts as present interest gifts. Those could be qualified under a crummy use that Tom can talk to you about to qualify the $14,000 annual exclusion as present interest gifts. Those are all countable, though. The premiums you will pay under those $14,000 or $28,000 limits if you split a gift per heir. Or you can go into your lifetime exemption, current lifetime exemption, where you'd start to need to file a gift tax return over amounts over the annual exclusion amounts. That would start the clock running on gifts while you're alive, but know that the life insurance needs to qualify as a present interest, and then the trustee utilizes those gifts to pay the insurance company the premiums that when a death benefit comes in under the policy, generally if it's a husband and wife, the type of insurance that is purchased is joint second to die, meaning that it insures both the husband and the wife because that's the most cost-effective way to insure the premiums, because joint life insurance mortality, when you have two lives and they base it on the female life, leads to lower premiums, and the insurance death benefit is paid when it's needed at the second death. So that's how the insurance trust planning would work. You could also have your children own the insurance outright to keep it out of your estate. Tom would have some opinions on that, I'm sure. Make sure you think that through very clearly, because that generally doesn't give you the most control or flexibility in your planning to do it that way. Lastly, I'd like to just talk about some sample kind of numbers out there so you could see why life insurance. Generally, I hear three things. I have enough life insurance, I think life insurance is a lousy investment, or I just don't like life insurance. Those are the three categories of objections I generally hear. And in this slide, what I want to show you is a male age 65 and a female age 62. We're illustrating $5 million of coverage on the next slide here, Jim. That'll show you on a guaranteed basis, you could make gifts of $60,000 a year under the far left column under this insurance. There's three insurance companies highlighted on this spreadsheet, assuming you were preferred health. And for 20 years, you could pay $1.2 million in premiums to this insurance company, and they would deliver $5 million of income, estate, and gift tax-free money if properly owned and structured outside of your estate at the second death. And the key thing here that I want you to focus on is on the next page where you look at the question about, is life insurance a good investment? Let's face it, when you have an estate of this size, you're not going to be able to spend down your comfort cash where it would affect your spouse's enjoyment of their lives. So in gifting these premiums, you're essentially spending your heirs' inheritance early for their benefit. And you would ask, as a fiduciary, what is a good, safe, competitive investment grade return? Well, in this policy that I just referenced, paying $60,000 a year for 20 years would deliver a $5 million guaranteed death benefit, and out at joint life expectancy, and that's year age 86 of the youngest insured here, the after-tax death benefit return would be an 8.82% return, which, again, I know it's not what you want to do to have death occur at a second death here, but we all are going to die. And in this case, using those $60,000 of premiums would yield an 8.82 guaranteed return, subject only to the credit risk of the insurance company offering the policy. And obviously you want to make sure that you're being insured with a AAA rated carrier, and that's for your insurance advisor to make sure that they have researched for you. If you think about this in terms of pre-tax equivalent returns, because my clients generally say, Don, well, that's great after tax, but I've got investment monies right now, or hey, I'm even got money in Wells Fargo Bank or Bank of America or First Republic Bank that I'm earning nothing on right now. Well, I then gross it up about the pre-tax at capital gains rate, or if all of their investments were at ordinary income tax rate, you'd have to get a 13.8% return if all of your investment income was being generated at capital gains rate to equate with the 8.82 in California right now at the top marginal rates to yield that. So what I like to say to clients, the ones that say life insurance is a lousy investment, I say, okay, well, if this is lousy and you're earning more on this on a fully guaranteed basis, then we don't really have anything else to talk to. But for those clients that say for a portion of their portfolio they want to protect kind of the cow so that they can use a little of the milk in terms of premiums to protect the cow long term for the family, it might be a good thing for them to consider. So that, Jim, is really in essence the insurance solution that would be utilized in estate planning in today's environment.
Thank you, Don. That was great. Great combination with Tom Bret and Don Morris, with Tom setting the current environment, current issues in the estate planning environment, and Don offering some really significant and relevant solutions, certainly for large estates. Submit your questions now. We'll make sure those get answered. And here's all the contact information for Tom, Bret, and Don Morris. So that'll be recorded on our website. And as I said earlier, if you would like a set of these slides, just email us and we'll get those out to you. So I want to thank my good friends here, Tom, Bret, and Don Morris. It's very helpful for our community. We have some webinars coming up. Next one will be on November 19th. That's for our clients only. That's our quarterly investment committee update. And then for everybody on Wednesday, December 17th, we're going to review 2014 and look forward to 2015, certainly from an investment context. There's many ways to follow us and keep in touch. We encourage you to do that. We're always here to answer your questions and be a source of help. Thank you very much for joining us today, and we'll look forward to interacting with you in the future.